Hello everyone, welcome to Tesla Daily News. Today is June 11th, Thursday, and the following is the latest Tesla news. According to market data, Tesla shares closed at $381.59, down from the previous close of $396.68. The stock opened the day near $391.54, briefly ran up to an intraday high just above $397, and then slipped to a low around $380 before finishing slightly above that level. Trading volume was heavy at more than 49 million shares, indicating active positioning after the recent rally. From a technical perspective, Tesla is pulling back from resistance after a sharp run, with buyers defending the $380 zone on the first test. Optional technical take: short-term pullback toward support after failed breakout. For investors, the key takeaway is that Tesla is still in a very elevated valuation range, in part supported by expectations around full self-driving, energy storage, and AI. The wide intraday range suggests some profit-taking and short-term volatility, but the fact that the closing price held above the session low signals that dip buyers are still present. Going forward, traders will be watching whether 380 holds as near-term support and whether the stock can reclaim and hold above the mid-390s to re-challenge recent highs. Longer-term shareholders may view this as a normal consolidation phase after a strong move, rather than a shift in the fundamental narrative. According to Clean Technica, General Motors just announced a major expansion of its energy and software ambitions, including activating vehicle-to-grid capability for existing GM EV owners with no new hardware required. This is not directly a Tesla announcement, but it matters a great deal if you follow Tesla as an investor or enthusiast, because it highlights how quickly legacy automakers are trying to close the gap in vehicle-as-a-grid asset functionality. GM says it already has over 250,000 bidirection-capable EVs in the United States, and is now turning them into potential grid resources, allowing cars to send power back to the grid when utilities support it. The company emphasizes that in theory, the current fleet could power roughly 120,000 average U.S. homes for up to a week. They are running pilots with utilities like PG&E in California and DTE Energy in Michigan, and are calling on regulators to streamline enrollment, incentives, and interconnection for vehicle-to-grid services. For Tesla investors, this is strategically important. Tesla has long promoted its ecosystem of cars, Powerwalls, Megapacks, and the Autobidder software platform as a way to integrate distributed storage into the grid. However, Tesla's vehicle-to-grid features have been rolled out cautiously and are not yet as aggressively marketed as GM's new V2G push. GM's move validates the overall thesis that parked EVs are a massive, untapped storage asset, which in turn supports Tesla's broader energy story. At the same time, it signals rising competition in grid services, where Tesla Energy has enjoyed an early lead. If GM succeeds in making V2G user-friendly and widely adopted, utilities and regulators will become more comfortable with EVs as active grid resources. That could indirectly help Tesla by accelerating the creation of tariffs, software standards, and regulatory frameworks that Tesla cars and Powerwalls can plug into. On the other hand, it also means Tesla cannot assume it will own this segment by default. Differentiation through software reliability, user experience, and integration with home energy products will matter more. According to Finanzen.net, a high-profile debate is emerging among Wall Street analysts, tech investors, and even some of Elon Musk's own supporters about a possible mega-merger between Tesla and SpaceX. The article discusses the idea that, after SpaceX's landmark initial public offering, a fusion of the two companies into a single technology conglomerate could create a corporate giant valued around $3 trillion, combining electric vehicles, AI, robotics, rockets, and the Starlink satellite internet network under one ticker. Investor Peter Diamandis is quoted as saying that, in his view, the question is not if, but when Tesla and SpaceX eventually come together. His argument is that fully autonomous vehicles and humanoid robots need ultra-reliable, global connectivity, and SpaceX's Starlink constellation could provide that backbone. A combined company would control both the AI-driven devices on the ground and the communications infrastructure in space, aligning with Musk's long-term visions, including Mars colonization. However, the article also outlines serious risks, particularly from a Tesla shareholder's perspective. SpaceX's core rocket and Starlink businesses are extremely capital-intensive and carry high technical and regulatory risk. Folding that into Tesla's balance sheet could increase earnings volatility and expose Tesla investors to launch failures, delays, and massive ongoing capital needs in space infrastructure. Furthermore, Tesla currently enjoys a pure-play branding in EVs, AI driving, and robotics. Merging in a rocket and satellite business could complicate valuation metrics and investor perception. Another angle raised is index inclusion and capital access. SpaceX faces a delay in joining the S&P 500 index after its IPO because of strict eligibility rules, meaning it misses automatic inflows from index funds. A merger with Tesla, which is already a heavyweight in the S&P, would effectively bypass that obstacle, giving SpaceX immediate access to Tesla's deep capital markets footprint. But that same mechanism would also mean Tesla shareholders help finance Starlink expansion and deep space projects whether they want to or not. For Tesla enthusiasts, a combined entity is an exciting narrative: autonomous Teslas communicating via Starlink, humanoid Optimus robots tied into the same network, and a unified AI stack across Earth and space. For conservative investors, it raises a fundamental question about risk tolerance. Crucially, the piece reminds readers that any such transaction would require approval from both Tesla and SpaceX shareholders, so this is not something Musk can implement unilaterally. For now, this remains speculation, but it is worth tracking because it could reshape Tesla's risk profile and growth story if it ever moves from rumor to reality. According to The Motley Fool, the upcoming SpaceX IPO will still leave Elon Musk in an extraordinarily powerful position. He is expected to control about 82.4% of the company's voting rights after the listing. The article focuses on what that means for investors in Musk-related companies, including Tesla. The author points out a dual reality. On one side, such concentrated control means Musk can steer SpaceX's direction almost single-handedly, limiting traditional corporate checks and balances. On the other side, his immense equity stake gives him significant skin in the game. His personal wealth is tightly coupled to the long-term valuation of SpaceX, incentivizing him to work aggressively to increase shareholder value. This discussion parallels Tesla's own history. Tesla's premium valuation trading at many times earnings and sales is partially attributed to investor confidence in Musk's ability to identify, build, and scale transformational technologies. The article argues that while Musk's record is not without controversy, he has shown an ability to pivot strategies when needed and to keep a loyal shareholder base aligned with long-term goals. For Tesla investors, the key implication is that Musk's increasing financial and strategic leverage over SpaceX may deepen his focus on the combined Musk ecosystem: Tesla, SpaceX, Starlink, and potentially XI and other ventures. That could eventually encourage closer operational or financial ties between Tesla and SpaceX, even without a full merger. It might translate into shared AI research, joint connectivity solutions for autonomous driving via Starlink, or cross-company talent and hardware synergies. The upside is a more powerful network of mutually reinforcing businesses. The downside is that Musk's attention and risk appetite are spread across several ultra-ambitious projects, and shocks in one area could spill over into sentiment around Tesla. According to multiple Scandinavian outlets, including Avisen DK in Denmark and Aftenposten in Norway, Denmark has now granted a temporary regulatory green light for Tesla's full self-driving supervised system on public roads, making it the first country in the Nordic region and the fourth country in Europe to approve this version of FSD. The approval flows from an earlier assessment by the Dutch authority RDW, which concluded that FSD Supervised can improve road safety when used as intended. In practice, this means that owners of Tesla Model S, Model 3, Model X, and Model Y in Denmark will soon receive an over-the-air software update enabling FSD Supervised, subject to a paid subscription. The Danish Road Authority emphasizes that the system is still classified as an advanced driver assistance feature. The human driver must stay fully responsible at all times, remain attentive, and be ready to intervene. The car monitors driver attention and can force disengagement if the driver appears inattentive. The approval is provisional because it depends on a broader decision by the European Commission. If the Commission ultimately declines to support the Dutch framework, the current approvals in the Netherlands, Denmark, Lithuania, and Estonia could expire after 6 months. The timing and details of the European decision are not public due to confidentiality rules. For Tesla, this is strategically significant on several levels. First, it expands the FSD revenue opportunity in Europe beyond early test markets, opening a subscription-based, high-margin software stream in a region with strong Tesla adoption. Danish estimates suggest that roughly 30,000 of about 95,000 Teslas in the country can use this version of FSD, with a monthly fee in the hundreds of Danish kroner range. Scaling that across more European countries would create a sizable recurring revenue base. Second, regulatory endorsements like this strengthen Tesla's core narrative that its AI-driven autonomy stack can materially improve safety. Danish authorities explicitly say they see FSD Supervised as comparable to other driver assist systems and as a contributor to traffic safety. If, over time, European data show fewer accidents per kilometer with FSD active, it will bolster Tesla's marketing claims and may influence both insurance pricing and regulatory attitudes. Third, Denmark's move puts gentle pressure on other European regulators, including those in larger markets such as Germany, France, and the Nordic neighbors, to consider whether they are willing to lag behind on autonomous features. For investors, each new country approval de-risks the global FSD monetization thesis and strengthens the idea that Tesla can transition from a hardware-only margin profile toward a combined hardware plus software subscription model. According to InfoBay, Tesla is highlighting the depth of its active and passive safety technology, reinforcing its long-standing claim that the safest crash is the one that never happens. The report notes that Tesla now has a global fleet exceeding 8.6 million vehicles and uses this massive data set to refine both its driver assistance algorithms and its crash mitigation systems. On the preventive side, Tesla vehicles automatically adjust seating and mirrors to the driver profile, continuously monitor surroundings via external cameras, and provide real-time alerts for objects, pedestrians, lane departures, and blind spots. They also include drowsiness detection to warn drivers showing signs of fatigue. If a collision risk is detected, the system can highlight the threat on the central screen, sound audible warnings, and, if the driver fails to respond, trigger automatic emergency braking by reducing motor torque and applying the brakes. On the passive safety side, the article emphasizes Tesla's engineered crumple zones around the rigid passenger cell and battery pack, designed to absorb and distribute crash energy away from occupants. Airbags are described as adaptive, adjusting deployment to the type of impact and the size of occupants, with side airbags and even airbags between front seats to prevent passenger-to-passenger collisions and side impacts. Belt pretensioners can be primed based not just on impact forces but on camera analysis in the milliseconds before a crash, allowing more precise tightening. For Tesla investors, this sustained focus on safety has several implications. Strong safety performance reduces long-term regulatory risk and reinforces Tesla's brand moat, particularly as regulators scrutinize autonomous driving systems more closely. Safety leadership also supports Tesla's ability to negotiate favorable insurance partnerships and perhaps expand its own insurance offerings, an area where data and real-world performance matter a great deal. For FSD adoption, convincing customers and regulators that the system not only drives itself but does so more safely than a human driver is essential. According to the Daily Mail's coverage of the Auto Express Driver Power 2026 survey, the Tesla Model 3 has been voted the best car to own in the United Kingdom, topping a list of 50 models based on feedback from more than 100,000 drivers. The Model 3 received the highest overall satisfaction rating and ranked first in several categories, including engine and gearbox performance, safety features, and quality and reliability. Owners particularly praised the smoothness of the drivetrain, with the Model 3 being the only car to receive a perfect score in that category. Acceleration was another standout, with the performance variant capable of reaching 60 miles per hour in under 3 seconds, helping the car secure a top ranking for driving enjoyment. The Model 3 also scored highly for range, with official figures from the low 300s to the mid 400s of miles depending on configuration, making it the best-rated EV in the survey in terms of usable range, even though overall efficiency rankings across all fuel types placed it a bit lower. An interesting detail for longtime observers is that quality and reliability scores for the Model 3 have improved significantly compared with earlier years, when Tesla often landed near the bottom of quality rankings. In this latest survey, the Model 3 now sits near the top of the pack for both build quality and reliability, reflecting ongoing improvements in manufacturing and fit and finish. The main weak points cited by owners were exterior styling and brake feel, but these did not materially drag down the overall satisfaction score. From an investor's standpoint, this recognition is important because owner satisfaction in a mature and highly competitive market like the UK tends to translate into repeat purchases, positive word of mouth, and stronger residual values. High satisfaction with safety and reliability supports premium pricing and helps counter lingering narratives about inconsistent quality. The improvement in survey scores over time also suggests Tesla's manufacturing learning curve is still moving in the right direction, which is critical as the company scales globally and introduces more complex products like Optimus robots. According to Handelsblatt, German automakers BMW and Mercedes-Benz are rolling out a new generation of electric vehicles designed explicitly to close the gap to Tesla and Chinese competitors on range, charging speed, and software. While not about Tesla directly, this is strategically relevant because it shapes the competitive landscape in one of Tesla's most important regions. The report characterizes the new EV race as a kind of decathlon, where success requires excellence not only in battery energy density and cost, but also in thermal management, aerodynamics, software integration, power electronics, and charging infrastructure. BMW and Mercedes are investing heavily in more efficient battery packs, optimized vehicle platforms, and faster DC fast charging capabilities. The goal is to match or surpass Tesla in real-world range and to reduce charging times enough that long-distance travel becomes nearly as convenient as with combustion cars. For Tesla investors, increased competitiveness from German incumbents is both a challenge and a validation. On one hand, it pressures Tesla to keep innovating on powertrain efficiency, charging curves, and in-car software to maintain a clear lead. On the other hand, as more high-quality EVs reach the market, they accelerate the transition away from internal combustion engines, expanding the total addressable market for all EV makers, including Tesla. If Tesla can retain a strong technology and cost advantage while the overall EV category grows, it can still gain absolute volume and revenue even if its market share percentage fluctuates. Though the article is primarily about BMW and Mercedes, it implicitly underlines Tesla's current benchmark status. German engineers are designing to catch Tesla on metrics that matter most to consumers: range, charging speed, and digital experience. That ongoing benchmarking is itself a sign of Tesla's enduring influence. According to Haber 7 in Turkey, Tesla has launched an official trade-in program in the Turkish market, allowing customers to bring in their existing vehicles regardless of brand and apply their appraised value toward the purchase of a new Tesla Model Y. The entire process begins online. Owners enter vehicle details, receive an estimated cash offer, and then finalize the transaction after a physical inspection at designated delivery points. This move comes as Turkey's auto market faces high interest rates, tighter credit conditions, and evolving tax rules around vehicles, all of which can make it harder for buyers to finance a new car. By providing a streamlined trade-in path, Tesla is effectively simplifying the upgrade decision and lowering the upfront cash barrier for potential customers. The trade-in value can serve as a down payment, reducing the financing burden. For Tesla investors, the new program signals continued localization of sales strategies in emerging and middle-income markets. Rather than relying solely on cash buyers or external dealers, Tesla is drawing more of the transaction into its own ecosystem, capturing margin on used vehicles and improving control over the customer experience. As Tesla looks to grow its global volume, particularly with more affordable models in the future, country-specific tools like trade-ins, financing partnerships, and local incentives will play a greater role in sustaining demand. Thank you for listening to Tesla Daily News. If you found this episode helpful, please subscribe and share it with other Tesla enthusiasts and investors.